Welcome. My name is Dave Hardin. I'm here with my co-host Kyle McCauley for Einstein Retirement 360. This is a podcast where we just cover everything concerning retirement. Today we're going to talk about an interesting subject, biases, confirmation biases in the world of retirement planning. What does that mean? What does that look like? And Kyle, we got to this because I recently read an article about confirmation bias, it really took me back. So as I'm reading this and digging in, I'm starting to really think through, because everybody has some form of confirmation bias in one way or another. We all have them when we're doing things, and we'll talk a little more about what that looks like. What does it mean? But I recalled an episode of my own where I was sort of struck by confirmation bias in a process way back in the tech bubble. I think back to a 1999 episode where I was looking for to purchase some stock, an individual stock, and back then, I remember people telling me, we were in the, it was one of those days where you thought you could throw a dart at a dartboard, and if it had 4 letters next to it, you were going to make $1 million. It was
this was in the 90s?
Yeah, in the late 90s when the tech bubble was just exploding. And it did, what's amazing about that is you start reading, you're digging in, and I know when I was making the decision to purchase that stock, it was a bad decision for me. Mm-hmm. But I didn't understand why. And everything I read seemed to say, good decision, great stock, great opportunity, great perspective. I won't go into the details about the stock, but they're out of business in 3 years. It was not a good purchase.
You bought it in like 1997?
No, I bought it in. I bought it in. I think it was 98.
Okay.
But they were just. It was a downward slide.
But first, it was a beeline up.
It was a beeline up, and then it was a big downward slide, and everything was going up, but not necessarily for great reasons. There was just a frenzy in the marketplace, and everybody was buying without regard to any real value. And so I got caught in that, and I remember thinking afterwards, why did I do that?
Did you just buy one stock, or did you buy a few?
This is one specific stock, and I bought a lot of it. So,
but you only bought one?
Just one.
Okay.
No, I had other holdings, but that particular stock, I put grandma's, jewelry in it. It was one of those things that you don't talk about too much, but it really I
can tell you sort of don't you want to share the story.
Yeah,
no, but you also don't want to talk about it.
I don't really want to talk about it. I'm uncomfortable bringing it up even now. But the fact is, afterwards, I figured out what happened was that I was just sure.
Okay, so hold on. I want to make sure.
Yeah.
Because I don't really know the story, and I'm hearing you, and I'm trying to get a grasp of what happened. So you had investments, a bunch of investments.
Correct.
In you've been saving for years.
Correct.
Okay, so at some point, you carved off a chunk of that, or you took additional money?
I took additional capital.
Okay.
That really wasn't meant to be an investment at the time, because this was a really good deal.
Okay.
And
so this was money that you had kind of set aside, like emergency money.
Yeah,
almost?
That kind of stuff.
Okay.
The kind of stuff that you really shouldn't be investing. Okay. That you take a flying leap on sometimes because you're just absolutely sure you're going to do well.
I'm with you.
Yeah.
Okay, so you saw everything in your regular investments going up.
Yeah, absolutely was doing that, but I wasn't. I was pretty diversified at the time, too.
Yeah, but you saw your tech stuff.
Absolutely doing wonderful.
Okay, and so you thought, you had a friend, or who talked you into this?
Yeah, it's interesting. I had 2 different people who I had a lot of, they had done really well in the tech market, almost exclusively in the tech market, and their returns were outshining my returns by a big, hefty margin. I see. And
so you were hearing them.
Yeah.
Talk about, hey, oh my gosh, I got 100%, 150%, like that kind of returns?
Yeah, well, in the 80s and 90s, and I wasn't getting in the 80s and 90s, and they were, so one of them was a smart guy, but doubling down, doing margin, buying and things like that, he went from, maybe 3 years earlier, about 20,000 to about $1 million. He had just blown his account up, but he was also highly leveraged.
Yeah. Okay.
And I wasn't that guy. I was never going to be that guy.
So who picked the ticker? Was that him?
No,
he said, "Hey, this ticker."
Yeah, both of them said it independently to me.
Okay.
And that it was like, there's used to be this guy. Well, I guess he's still on the air. I probably shouldn't name his name. That people would look to, as the bells and whistles.
Okay,
and the buttons
people
and
know
stuff.
who he's talking.
You know who I'm talking about. So that guy. So I know people who have, if you look at his investments over a long period of time, not necessarily have done very well, but he's great at selling the idea that this is an up and coming. Well, that was happening. It was happening internally to me, and my bias at the time was the default was, well, how bad can this be? The market is going crazy.
Yeah. So what if I lose 40%? I'll gain 80.
Yeah.
Okay.
So I took the flying leap.
Okay.
And when you get, when what happens.
So did it go up at first?
Yeah, it went way up. It went up. I was up probably 40% in maybe about 6 months.
Okay.
And then I was down 80% in about 6 more.
Wait. Okay, so you went up 40 in 6 months. And how long? It wasn't that long.
No, but by the end of the first year, I was down to 20% of my investment.
Oh, okay.
Yeah.
Okay.
Yeah, and what's worse is...
Yeah, you lost like 90%.
Yeah, I did. So worse. What's interesting about that process for me was watching my reaction to the loss was as interesting as my reaction to making the purchase.
Yeah, okay. So when it was going up, did you have any inkling to sell? No feelings of selling? No, okay.
No,
and that was because
the sky was the limit on this thing. It was going to change. This was like the next Intel or Yahoo, or those things were just and you felt there was a frenzy in the market. Like you felt like if you weren't doing those things, and you had to get to them before they made this stratospheric rise to take any advantage. If you didn't do it, you weren't going to do it. You might get decent returns, but you weren't going to do that. Mm-hmm. And I had visions of retiring, at 45 or something. So maybe that would happen. It was just a ridiculous thing. But caught up in the market, I wasn't the only. I promise you, some of our listeners know exactly what I was talking about. Sure. But maybe many of them. But the process is a very different thing than in 2008. Yeah. Or 9 when the market was was devastated, but not there wasn't a huge uprise. Maybe in the real estate market there was, and then a terrible downturn. But tech stocks were everything in me said it's the future. Okay. This can't take a dive like that because everything is changing. The internet was, for people like me who didn't really understand what the internet was 6 years earlier. Mm-hmm. And then being introduced to it and thinking, this is the greatest thing in the world. Where is it going? And seeing all of these different things come around. The personal computer was on fire. Microsoft was, we see guys being billionaires already who were investing early in Microsoft and thinking, these are changing lives.
Okay, so you saw your growth, and then you saw it start to come back.
It took a big turn early, almost 25% in about a month.
Down 25% in a month.
Down. But I'm still up. Right. I'm still up at that point.
So you think it's going to keep turning?
I think it's just a little correction, short term. In fact, the voices in my head and the things we were reading were people were gathering profit taking, and so as soon as the profit taking was over, we'd be back on the slide up. And what am I going to do? Take my profit and miss the next slide up? Not going to do that. Because I'm convinced that this is going to the stratosphere. It's the next big one. Mm-hmm. And
your friends, what are they saying?
Well, they're quiet at that point.
Oh, really? They don't say, no, Dave, don't worry?
Well, understand, a 25% decline in the market for them
was 50.
Because
they were leveraged.
Correct.
I see.
And they were not talking to anybody. They were clammed up like clamshells. And
that didn't concern you?
Well, they didn't tell me.
Oh.
I didn't find out for probably a year later that was going on. When one of them was filing bankruptcy, I didn't really understand what was going on. And I didn't understand they friends don't say, hey, by the way, I'm 50% leveraged on this stuff.
Right.
They just tell you how much they're making, and
I see.
it's stratospheric rise. You don't find that out until
Later.
you're having a very serious conversation later about losses, and they're like, oh, you think you're bad? Look at me. And I'm like, oh,
it's always a competition.
yeah,
right
right until the end.
it's
yeah,
a competition. My losses are worse than yours.
Or down. It's a competition either way.
Okay. All right.
So yeah, and then it kept getting worse.
Okay.
But there's a point where I'm down. Now I'm down actual capital, and I'm hurt. Now I'm like, something's wrong. But it's like, I still believe all the press that led me to make the decision was still in my head. It was still a great principle. It was still a great stock. Company had everywhere to go, great opportunities. It was going to change America, all those kinds of things. So what's going on? Well, this is the interesting part. This is the part that when I look back afterwards, I realized there was actual confirmation bias going, because the whole market in the tech world is going down. But in my mind, my stock is different. And it's only suffering because of the tech bubble. And my stock's got to come back, because all those other things, they may have been, just frivolous things. The tech bubble is too built, but all the internal combustion that makes this go is still working. It's still real. It's still viable. And what's interesting about it is, for many of the stocks that did this catastrophic, terrible turn, that was true.
Right.
Just wasn't for mine.
Or eventually they came out of it.
Yeah, well, they did. So you look at a Yahoo or a Microsoft, IBM, not IBM, but Intel. All of those fell in that bubble, but the good companies absolutely survived and did well. Right. And the stock price. What's interesting to me is the stock price doesn't have a lot to do with the actual company. The company still has its capital.
Right.
In fact, many of them saw opportunities to buy their own stock with the capital they had, because they believed in what they had and they knew it was going to do well, and it did well for them. But people, there's this thing about people selling at the bottom that sort of happens, and eventually you have to, you decide what you're going to do. Am I stick with this thing that's just stabbed me in the back for the last year and a half and taken all of my money that I didn't really want to invest? Do I walk away from this thing, or do I hang on for the next 20 years and hope it recovers?
Do you still own it today?
No, I don't.
Okay.
So, no, I don't. No, I don't. It was one of those companies that just sort of disappeared. So I did hang on for a really long time, but when it gets down to the pennies,
right,
you start to go, this is not what I thought it was.
Right.
And finally, something of truth hangs in that company is not the company that I was hoping it would be, and it doesn't really have any of those things. It's just similar to things that do. But I picked badly. I mean, this is not the only time I've ever picked a bad stock, but that one hurt more than any other one I can remember. But it was shortly after this, the confirmation bias, I started reading about it and realizing that as I was preparing to get that stock, I'm hearing my friends, I'm hearing all the articles about the market going crazy, about the world changing because of tech, and all of this stuff. And every article I read, every conversation I have, that stock is placed in the middle of the good stuff, and it soaks it up. All the good press gets. Now there's bad press, but somehow it doesn't get weighted the same way. And what I do in my head is start justifying why the good stuff applies and the bad stuff I can ignore. And I think that's what confirmation bias is.
Yeah, well, confirmation bias obviously is going to be, when you find, you make a decision, and then you find, this is the short description, and then you find evidence to support the decision that you've already made.
Right.
So you make the decision for whatever reason. Like your reason was because your friends talked you into, they goaded you essentially. Your friends had goaded you, your competitive nature, your competitive streak, they goaded you into buying this stock. And so you'd already made the decision that you weren't going to be left out of this big rise in technology,
Right.
that you were going to go after the returns. But everything you saw after that was just there to confirm your decision. So you weren't looking for evidence you weren't evaluating whether it was a good decision or not at that point. You were just looking for evidence to support the decision that you'd already made.
Yeah, I think in my mind, I made the decision.
Mm-hmm.
I kept telling everybody I hadn't made the decision,
Mm-hmm.
but there's something clicked that I was going to do it.
Mm-hmm.
Then I was just looking for a way to justify in my mind actually doing it.
Yeah, right.
And that's really easy to do when there's, on a given day, you can read the news, the financial news, and you can read two stories about the same company, and one is glowing and one is horrible. It's just perspective. The problem is there's always that kind of competing information out there. It's how you look at it that makes a determination of what you do with it. And the problem is if I approach that, like I did with this, with a set, I've already got this idea that I want to do this, everything sort of slides to the right of do it. Yes, it's good. Yes, there are reasons to do it. It's justifiable. You're going to do well. This is great, great for you. And let me tell you why there's caution here, are just, they don't weight the same way. The scales of justice just don't do this. They weight so much in the favor of whatever my bias is that I've already figured out. Now, the problem is, I don't think I know that I'm biased when I'm doing it.
Mm-hmm.
I think it's there. We have inherent biases for all sorts of things that aren't true, but we also have biases for things that are, and the confirmation of those sort of feed the biases that aren't, and it's a problem. But
well, interestingly, I mean, just not even just in the world of investments, but just looking at something as simple as a Social Security decision. If you were to look for the top videos on about Social Security, like on like a YouTube or something like that, you go in and you see, okay, what are the most watched videos on Social Security? One of them is like 10 reasons to collect at 62.
yeah,
Why is that one the most watched?
if I had a nickel for every person that said to me, well, I don't know if Social Security is going to be around, so I want to take it as early as possible. I mean,
But
cannot
the
tell
point
how many times
is
I've heard
that people make the decision, I'm going to file at 62.
Right.
And then they gravitate towards things that confirm that
confirm
decision
that bias.
confirm that decision is the right decision. Yeah. So there are lots of people where 62 isn't a great age to file. And so, if they've already made the decision, though, it's not going to matter, because all they're going to do is they're going to go out and look for the videos or the articles that tell you why filing at 62 is the right decision.
Yeah.
And they're out there, right? You can absolutely confirm any bias that you have. We see this politically. We see this with your religious beliefs. I mean, everything. There's confirmation bias that you can run into. So when it comes to finances, I would say that, I think this is one of the reasons why you are bringing this topic up, is that we see clients have issues with this confirmation bias all the time.
All the time.
And, confirmation bias would be something to the effect of, well, I don't want to own bonds, right? Because I look at the yield and the yield's very low. Okay, totally understandable. Lots of reasons why not to buy bonds, right? Now, it depends on what you're talking about. Are we talking about individual bonds? Are we talking about bond funds? How exactly are we buying these bonds? But, an investor who wants to get 9% has a hard time convincing himself to buy bonds when the yield is 2 or 3%.
Right.
Or if a bond fund 1.5%
Right.
on an investment grade, low risk type of a deal. So it becomes very difficult. And so the bias is, well, I don't like bonds. And so then what does confirmation bias do? Why are bonds bad? That's the Google search. You gonna find something?
Probably a million articles.
Should I buy bonds?
Million articles
That will say yes and no.
And no.
But which ones are you going to see if you're biased
the ones
against
that say no.
Yeah, if you're biased against them, you're going to automatically look, well, this one says they're okay, but that doesn't seem like it's so great.
Or I read the one that says, here's why you should, and I'll start to go, yeah, but that doesn't apply to me.
Right. Yeah, well, but you just read the headlines first, right?
Yeah.
And the headline, what's the right amount of bonds? Well, clearly not the whole thing, because they wouldn't be asking that. Okay.
Yes.
So then you go to the next one. Bonds may not be the best option for today's retiree. Let me click that article.
Yeah.
Okay, so that becomes the problem, is that's where confirmation bias sets in. And so we tend to start overlooking things. We also will get confirmation bias when we're convinced that we want to continue to hold positions, maybe that we shouldn't hold, like in your case. So, a lot of 401k plans have index funds, right? So I'll look. Index fund investing, is it the right way to go? Yes, it's the greatest thing ever. Oh, see, there's 10 articles here that agree that, so I'm going to stay index funds only. And we just are confirming our biases. That's all we're doing. And so we can really make some big mistakes when we don't allow an actual consideration of the pros and cons, the multiple sides, to inform our decision making, because we're really just focused on confirming our biases. Now, sometimes confirmation bias can work in our favor.
How so?
When we happen to be guessing that the decision we want to make is the right one.
I guess so. That totally makes sense.
So if the decision that I want to make is actually, as it turns out, the one that is best for me, then confirmation bias helps you, because it really solidifies you fast. I mean, that's one of the things about confirmation bias. If you feel that, how do you know that you have confirmation bias? If you feel very resistant to an opposing point of view. Okay, if you feel very resistant to an opposing point of view, you're probably dealing with confirmation bias. The decisions that you're making, the ideas that you have about your investments or your Social Security decisions or your pension decisions or retirement timelines or how much to spend, if you have any resistance to a differing point of view, what that means is that you're probably having an issue with confirmation bias. Because confirmation bias causes you, again, to want to focus on the things that agree with the decisions that you've already made. Things that go against that are impeding upon that good feeling, because it feels really good, right? It feels
Sure.
Confirmation bias feels good. It feels good to have things justify
Everything
my
lines
point
up
of
for you.
view, right?
Yeah.
So very easy to stay in that. I would say that the other thing that we often will see people get a confirmation bias, where this can really get in the way, is when it comes to, say, certain types of investment products or solutions or strategies. Because
Give me an example.
a great one would be like options. Okay, the most common thing that I will hear anytime we're discussing the option of, I didn't want to use the word option, the possibility. Anytime we're discussing the possibility with a client about using options, either both to protect a portfolio or to maybe get a little bit more out of a portfolio, anytime that comes up, almost without exception, the very first thing that I will hear is, I don't understand options, they seem really complicated. Well, again, 10 minutes of Google searching, are options complicated? And all you'll see is yes.
Yeah.
Okay? Whether it's good for you or not. And options are complicated enough that it means you have to know what you're doing, But if you get kind of locked into this idea, they're too complicated for me. I only want to do things that are simple, easy to understand. It can really cause you to miss out on opportunities. I would say that some of the people that we have interacted with at Einstein Retirement Workshops, some of them they've saved more than enough, right? They've saved more money than technically they needed to reach their retirement goals. But we see a fair number of people that have really saved just enough. And doing those things to get a little bit more out of their portfolio, doing those things to add just that little extra layer of protection is super meaningful and incredibly important. It could be vital to, say, an average retiree to have just those little points of optimization. But if you allow yourself to be closed off because of that confirmation bias, it can really get you into trouble.
Interesting. So there's this tendency, particularly, I hadn't thought about complicated things. The bias could simply be too complicated. Don't really want to have to figure this out. Afraid to maybe go down that road because it's hard.
Mm-hmm.
And so just easier to say, I like to keep things simple. Let's do something more simple. And yet, I might be leaving lots on the table because I didn't do that.
Right. There again, for some people, it might be just a matter of leaving lots on the table.
Correct.
For other people, it might be the difference between a successful retirement or not.
Yeah, that's such a huge thing because sometimes you don't know. And that difference can show up 20 years from now, and it can be a huge difference in terms of the actual outcome for the client.
I would say one of the other big biases that we're seeing a lot right now, and it's not confirmation bias, it's a different bias actually, but it's probably the biggest problem for today's retiree, and that's called recency bias. So recency,
You're talking about the markets right now.
Yeah, right. Recency bias would tell us two things about the markets. One, they're going to go up, right? We can't beat the market. Can't beat the market. Look at these returns. Okay, so that's number one, and that's again recency bias that's causing that. Recency bias issue number two with the markets. Really, I have to tell you, Dave, I'm very concerned that this might hurt a lot of people because this particular recency bias causes people to not appreciate risk correctly. In some ways, it was easier having the last big downturn in the market be the 2008 housing crisis. Why? Because the government didn't really bail out the stock market.
Right.
I mean, they say they bailed out some companies, but they did not bail out the stock market. That was a 53% decline. We did get a nice rebound, but nothing like an overnight turnaround. What happened with COVID?
Yeah, the Fed printed money like
30% decline.
Right. And
Interest rates plummeted to zero. Immediate recovery, V-shaped recovery. If anyone remembers, you heard V-shaped recovery. V-shaped recovery. That was everything in the news for like 3 months. V-shaped recovery. So it's a problem because now recency bias would cause someone to say, well, yeah, the market can drop. It's bad, right? 30% drop in the market. Yeah, it's bad. But it recovered really quickly. And then so you got to say the next statement. So if it drops another 30%, it's not going to be fun, but it'll just recover. It'll probably recover quickly. Maybe yes, maybe no. Okay, because 2008 did not recover quickly. Early 2000s, your dot-com bubble did not recover quickly. And so the recency bias sort of has been doubled down on. And I would kind of blame our federal government and the Federal Reserve System for how they handled things to create that mindset in people. And while we certainly like to see we deal with investing clients' dollars, we obviously like to see the markets going up. Fictitiously, I shouldn't say that maybe, but to see the markets go up simply because of inflation, the low interest rate environment, the money printing that we've been doing, to see it be primarily because of that, I think gives people an undue sense of safety about their investing. And so that can actually add risk to people, because what if in the next big market correction, the government doesn't bail the stock market out? What happens then? How are people going to get through that? And so I do think that there is sort of a recency bias showing up in those two ways. One, they assume the market's going to continue to perform as it has in recent times. Two, further performance, meaning even if it drops, it recovers very quickly. And I think those are two big assumptions that...
Those are big assumptions if you have that are absolutely wonderful to have if they happen.
Sure.
But terrible if they don't.
Right.
So if you act on those assumptions and it's not true, that the Fed eventually decides inflation is a bigger concern than bailing out the stock market, which they've never been concerned about before. I read somewhere recently, I think you might have pointed this out, that the actual liquidity in our economy doubled from 2014 to 2020.
Yep.
That literally twice as much cash and money in our economy, almost all of that winds up in the stock market, and it's still doing
Yeah,
that.
huge amount.
Yeah, it's just a crazy amount, and it's driving stock market. I thought about this last year. I think it was May. It hit me that in February we had almost all-time highs in the market. Then we had this terrible 30% decline, and then in May, the stock market in the middle of the pandemic, where a lot of companies are not operating or closed, the stock market all of a sudden is more valuable than it was at the all-time high. And you said this to me, since it's not the stock market.
Right.
It is not the stock market. The government is driving this. And
I said it's not the economy.
It's not the economy.
Yeah, it's not the economy. It's the stock market.
Yeah.
The stock market and the economy have never been more divorced.
Yeah. Well, and you've got to be sure. I mean, if you're 40, this probably doesn't make a big difference to you.
Well, I don't know about that, but you do get the benefit of dollar cost averaging.
And you have a lot of time to recover if the
Right.
market takes a terrible turn. But if you're in retirement planning, this is one big confirmation bias you do not want to overlook. And the problem, let me go back to this, because one of the things that strikes me, I'm wondering how you help clients pass this, because it is dominant in the way that you think. I mean, if you have a confirmation bias towards a particular investment or a way of investing or a risk, how do you overcome that? How do you?
Are you talking about the recency bias or
the recency bias that apply, but it's
which one?
I guess it's the recency bias right now, because there's so many. I mean, I talked to a fair amount of clients, and they're all like, the market's doing great, the market's doing great, and you've seen this. A lot of people will come to us, and they're way delved into the risk category, and it's paid off. That's the recency bias. It's paid off for them.
Mm-hmm.
They got the S&P's up 20% already this year, or something like that. 61% since March 24th of last year, after the decline in the market till the end of the year. I mean, it's hard not to love what's going on, but there is a problem. It's all recency bias, and it's not a really good plan to just say, it's sort of like it's exactly what I did in the late 90s. It's like I'm going to say something, you'll probably kick me after this. I saw a YouTube video about a week ago where there's this feeding frenzy of alligators in a lake. And I don't know why I'm watching this. YouTube thinks I'm interested. It must be, because I watched it. So in any case, but the feeding frenzy is going on, and at one point this huge alligator turns and clomps down on its baby.
Oh.
Because the feeding frenzy is so bad, but it grabs the baby and it eats it. And I thought to myself, I wonder if there's there's something about being so delved towards something that you ignore all the outside input. And there's a little bit of that going on in the market right now. People are ignoring risk that really shouldn't ignore risk, because they're afraid of loss, afraid of not catching this great upturn in the market that
Fear of missing
will
out.
never end. Yeah.
FOMO.
Yeah, that's right. So how do you overcome? How do you talk to clients about overcoming recency bias or confirmation bias?
Well, it's a lot. I mean, the only real way to deal with it generally is going to be a pretty lengthy conversation. Obviously, you have to highlight it and make sure that you realize what's going on.
Yeah.
Okay, and then you just have to point it out. Hey, I think what's going on here is that you're really just dealing with some confirmation bias. You're really dealing with some recency bias. So, one of the things you can do is to just ask yourself, look at the facts. Okay, so a great one is COVID. With COVID, market's down 30%. Let's say if the government doesn't step in, it goes down another 20, goes down to 50%. Okay? If that occurs, if it drops 30 and then drops another 20, rather than the V-shaped recovery,
Right.
how do you feel about your investments, if that's what had happened versus what did happen?
You're basically painting a picture. What if in March of last year we saw what happened in 2008 almost, or 2009,
Right.
where it doesn't go down 30, it then goes down another 20, we're down 50%, and it takes almost 5 years to recover. How do you feel about the market then? My guess is I would feel terrible about the market right then.
Yeah, many people
We
would.
saw this after the 2009 market crash. People were so hesitant to even go back in the market. In fact, I still see people today who have yet to really engage in the market because they lost so much in 2009. They pulled out and they missed an incredible. I mean, the S&P's doubled in the last 5 years.
So, you take the people that are going to be watching this video who say, well, that's not me, I would buy in. I would buy in. Yeah, well, you're probably one of those people that's still working. Or maybe you happen to have a lot of cash sitting around. I don't know what your situation is, right? Maybe you have a lot of cash sitting around. But the reality is if you're still working, it's a different scenario than once you're retired. Unless your employer is going to keep putting money in your 401k once you stop working, which I don't know anybody who has that plan. But unless you have a plan like that, you have to be very cognizant about the risk of loss. We say, well, I just won't sell, I'll hang on. Okay, so how long do you have to hang on for? The truth is, you don't know. I don't know. Dave doesn't know. You don't know. So you have to think through the possibilities. It's one of those, another reason why we run things when we're doing modeling of a client's portfolio and things like that, called a Monte Carlo simulation. Why do we do a Monte Carlo simulation? Because we need 1,000 reasonable trials to get a sense of what are the range of possibilities for how this could go. And so, yeah, there's the possibility that you have $1 million today, and 20 years from now you got 10 million. That possibility exists, but it also exists that you have 200,000.
You can't do a Monte Carlo without looking at all the good and all the bad.
That's right. So you need to just know that the bad case scenarios are possible. What are those bad case scenarios? What do they look like? Can you actually live with them? And if you can't, then it's time to restructure things and make those changes. But in terms of answering your question of how do we work with people to kind of help them through that, it's really just highlighting some of those realities. Do you really want to base your retirement on the hope that the government bails out the stock market the next time? Is that how you want to invest? You want to invest so like you need the government to bail out the stock market? I don't want to point out the obvious, but what if we had a different president who ran last go around who was not real big on the stock market? We had a couple of candidates who were in the running at one point who I'm not sure we'd have had a big action to bail out the stock market. So really, you want to bank on the idea that the stock market will get bailed out again? I don't know. Maybe that's your plan, but it's not a plan that I would feel super confident about.
So one of the things I hear you saying, and I realize we're sort of out of time, so we got to wrap up here, is you got to have a plan. Mm-hmm. So that plan has to be all encompassing. You got to look at the good, the bad, the ugly, all the things, And you got to be prepared for that.
You
Which
got to
means
take into account the variables.
Yeah, you can't just look at best case scenarios. You got to deal with that. So the next thing, if I'm hearing you, is if you're looking for an advisor, you got to find somebody that's not just agreeing with you and telling you you're okay. They've got to be willing to say, well, here are the risks. Here, this is what you're doing. Here's where that looks like, but here are the possibilities. And these possibilities, maybe they're too overwhelming to take that kind of risk. Or maybe they're not. In your case, anybody's case, it could be one way or the other. But you got to at least be open to looking. And then the other one is, I think you got to sort of look for different opinions, different than your own, and be open to seeing their value. That's the hardest thing I can think of, because it means I really have to change the way I typically think.
Yeah, let me say this too. For those of our listeners who are more savvy, okay, a little more in tune with your investments and things like this, you're actually at a higher risk for the things that we've talked about today. The people who are less in tune, less in touch, my experience in working with you folks is that you're really just trying to do the best thing. You don't necessarily know what the best thing is, but you're trying to evaluate, find an advisor who's got some expertise in retirement planning. You're like, okay, help me understand. That's your perspective. Those of you who consider yourselves to be a little more savvy, who are maybe proud of investment decisions you made over the years, you're the most susceptible to these types of biases, unfortunately, because your success has been great, but it's also what can kind of work against you and make you say, well, here's what I've done for my success, and then maybe you share that with a friend, and then all of a sudden you start to get input that says maybe the way that you're approaching things today isn't exactly the best way, and so you're quick to put those aside, because not only have you done well, not only do you have a recency bias that says, hey, things are still going great, but you're also very attuned to that confirmation bias, both that you've generated by sharing your successes with others, but also that when you start doing your Google searches and things to see, well, let me just Google search about this. And rather than saying, why is this particular strategy a good strategy, you type your search, why is it a bad strategy? So you can see all the bad stuff first, because it's different than what you're maybe thinking right now. So you just have to be really careful about that kind of stuff, because it can absolutely cause you to experience things in your retirement years that really you weren't planning on or thinking about, and were even legitimate possibilities. Not only are they legitimate possibilities, but now they're really hurting you. And so you just need to be aware of that and do what you can to avoid that kind of stuff.
Thanks, Kyle. Listen, this has been a wonderful time together. Thanks so much for the day. This is Einstein Retirement 360. We want to make sure that you know if we're doing, we always are open to having conversations about what you're interested in. We love having these conversations. There isn't much we wouldn't talk about in the retirement world or investment world, but we'd love your comments or questions. Any topic you think we would enjoy covering or that you'd enjoy hearing about, we're open to that. Just leave a comment. We'll certainly respond to that and do something about it. In the meantime, we thank you for your wonderful time that you spent with us today. I hope you enjoyed this conversation. This is Einstein Retirement 360. Have a great retirement.